lots in forex, standard, mini, micro, and nano. Get this wrong and your risk rule quietly breaks.
A standard lot in Forex is 100,000 units of the base currency. That's the anchor. That's the unit everything else scales from. Buy one standard lot of Euro USD and you're controlling 100,000 euros worth of position. A 1 pip move on that trade is worth $10. Up or down, $10 a pip. From there, the names just scale down by a factor of 10. A mini lot is 10,000 units, $1 a pip. A micro lot is 1,000 units, 10 cents a pip. A nano lot is 100 units, 1 cent a pip. Standard, mini, micro, nano. Each one 10 times smaller than the last. On your platform, those show up as decimals. A standard lot reads as 1.0, a mini is 0.1, a micro is 0.01, a nano is 0.001, and that last one matters because most regulated brokers won't let you trade it. The practical floor at almost every broker you've heard of is 0.01. That's a micro lot. 10 cents a pip on Euro USD. Hold that floor in your head, and hold this with it. The most dangerous number in this whole topic isn't the floor. It's the wrong number on a calculator that quietly wipes accounts. We'll get there. Now the part most beginners get backwards. They pick a lot size first, usually 0.01 because it sounds small and safe, and then they place a stop wherever the chart suggests. That's the wrong order. The chart sets the stop. The stop plus your risk rule sets the lot size. Here's the formula in plain English. Take the dollar amount you're willing to lose on this trade, say 1% of your account. Divide that by the stop distance in pips. Then divide it again by 10, because $10 is the pip value of one standard lot on Euro USD. The number you land on is your lot size. Worked example, $500 account, 1% risk, that's $5 on the line, 40 pip stop. 5 divided by 40 divided by 10 equals 0.0125. Mathematically, you'd want about 1¼ micro lots. That's the correct answer. It's also impossible to trade. Because the floor is 0.01, you can't enter 0.0125 on most brokers, so you round down, always round down, never up. Rounding up means breaking your own risk rule on every single trade, and you wrote that rule for a reason. 2% dressed up as 1% is how small accounts die slowly, without you ever spotting the leak. But notice what just happened. With the 0.01 floor and a 40 pip stop on Euro USD, you're locked into roughly $4 of trade risk, not 5. On a $500 account, that's about 0.8%. Close enough. Shrink the account further though, and the math snaps. $200 account, 1% risk, 40 pip stop, you'd need a nano lot to honor the math. Your broker doesn't offer one, so your options become shorten the stop to 15 pips, which the market will punch straight through, or accept that every trade is 2-3% risk instead of 1. Neither is acceptable. This is why experienced traders push a minimum starting balance of around $1,000 to $2,000. It's not snobbery, it's arithmetic. Below that line, lot granularity forces ill-sized positions on top of ill-sized stops, and the risk system you wanted to follow stops working before the trade even opens. There is one workaround, cent accounts. A handful of brokers, fbs-cent, Exness Standard Cent, RoboForex Pro Cent, let you trade in cent-denominated units. Effectively, you can size positions at 0.001 standard lots, which sits in the nano range that mainstream brokers don't offer. In practice, a $50 cent account behaves like 50 cents of effective pip exposure per standard lot. You can place a properly sized stop, follow a real risk rule, and count your losses in pennies, not dollars. This is not real trading. You will not build wealth on a $50 account. The point is execution mechanics. You're getting comfortable with the order ticket, with stop placement, with the discipline of holding a position when it's moving against you. The cheapest trading school on earth. Just don't confuse practice for performance. The psychology of risking 50 cents is not the psychology of risking $50. Build the habits cheap, then graduate. Here's where the lot concept gets weird. It extends to other markets, gold, indices, oil, single stocks, but the math underneath changes for every single instrument. Gold, 1 lot equals 100 ounces. A 1 cent pip move is worth $1 per lot, so at 0.01 lots, you're risking about 1 cent per pip on a metal that routinely swings $20 in a single session. S&P 500 CFD. The convention varies broker to broker, but typically one lot equals $1 per point of index movement. A mini contract drops that to 10 cents per point. Check the spec sheet. Some brokers just list one contract and don't tell you what the contract is actually worth. WTI oil. One lot equals 1,000 barrels. A 1 cent pip move is $10 per lot, meaning a $1 move in the oil price on one full lot is a $1,000 swing. That math sneaks up on traders who treat one lot as a universal size. Single stock CFDs are the simplest. One lot equals one share. You size by counting shares, not by guessing at decimal lots. The point isn't to memorize the table. The point is never assume. One lot in your Forex account does not behave like one lot in your oil account. Before you trade a new instrument, open the broker's contract specifications page. Every regulated broker publishes one, and read the pip value. That single habit has saved more accounts than any indicator on any chart. Most platforms now ship with position size calculators built right in. CTrader has one in the order ticket itself. MT4 and MT5 rely on third-party scripts from the MetaTrader community. TradingView has a calculator tool tucked into the drawing palette. Proprietary platforms, Pepperstone's panels, eToro's risk widgets, usually drop a calculator straight onto the trade ticket. Use them. They're faster than mental math, and they kill stupid mistakes at 4 in the morning. But, and this is the part nobody emphasizes enough, verify the output against manual math at least once a week. Here's the mechanism. A single misconfigured calculator set to the wrong pip value, the wrong account currency, or the wrong contract size for that specific instrument has wiped real accounts. This is not dramatic. There are documented cases of traders who trusted a default on a third-party script and turned what they thought was a 1% trade into a 15% trade. The calculator said 0.10 lots. They clicked. The market moved 50 pips against them. They expected a $5 loss. The actual loss was $50. Stop hit, account drained, no idea why. Manual math takes 30 seconds. Risk in dollars divided by stop in pips divided by 10 for Euro USD. Cross-check the calculator, then trust it. Verify, then trust, not the other way around. So here's where this lands. A lot is a unit, not a size. Standard, mini, micro, nano, each one 10 times smaller, with the micro at 0.01 being the practical floor at almost every regulated broker. You size from the stop, not the other way around. Round down, never up. And below $1,000 to $2,000 of capital, the math forces compromises that break your risk system before you ever place a trade. Either use a cent account to learn the mechanics, or wait until your balance can support a real position size. On non-Forex CFDs, the word lot still applies, but the pip value changes per instrument, sometimes dramatically. Always read the contract specifications before you trade a new symbol. And on calculators, use them but verify them. Remember the line from the start about the wrong number on a calculator quietly wiping accounts? That's the exact mechanism. A default someone forgot to change. A 30-second manual check would have caught it. Lots aren't complicated, they're just unfamiliar. Speak the unit fluently, size every trade from the stop, and the math stops being a mystery.
Lots aren't complicated, just unfamiliar. Size from the stop and verify your calculator. Full breakdown in the description.